A UTG approved must-have trading oscillator for identifying oversold and overbought market conditions. And we're even going to give you a free tool that will help you identify hidden levels to consider buys and hidden levels to consider take profits or shorts. We are, of course, talking about the RSI, the Relative Strength Index. We're going to show you everything you need to know about it right now. Yes, what is up, crew? Tex here with you from unitytradinggroup.com. And as I mentioned, today we're going to be looking at the RSI oscillator, the Relative Strength Index. An absolute staple of my trading system, a staple of Ads' trading system, and loads of guys that we've mentored or shared information with over the years. And I think by the end of this video, you will be a convert of the RSI. It's really is a staple of a lot of traders' arsenal. So let's have a look at it. So it was developed by J. Wells Wilder in 1978, and he created this tool, which is this one right here, for helping us to identify momentum of a trend. This is an oscillator, so it helps us to gauge strength of a trend, whether it be bullish or bearish. And as I mentioned, we're giving you our RSI tool, and I'm going to show you why this is so special in just a minute, but you can find that over at our TradingView account, which is the UTG RSI. And we'll link to it in the show notes as well. So it's measuring the strength of an uptrend. It's measuring the strength of a downtrend in short. So you can see it below here. We have our RSI line, and then we have these parallel bars. The numbers on the RSI go from 0 to 100. And then we have our lines here at the 70, which is considered to be the top of a momentum range, or the 30, which is the below the end of a selling market range. So the end of a buying market range, the end of a selling market range. This is a little bit outdated, this 70 and 20. And I'm going to show you how you can find something a little sneaky to help you avoid taking profits too early or taking entries too early as well. So as you jump into the settings, you will see this, which is our 14, 60, and 5. So if you know anything about moving averages, if you don't, top right-hand corner, I recorded a video on moving averages, the 3 types and why there's one type that I use over anything else and why I feel it's the best. Top right-hand corner, you can have a little bit of a look at that now and watch that video. I highly suggest you do. I wouldn't trade without moving averages. And I'm going to show you how you can pair them perfectly with this to stop giving money back to the market too early. So the RSI period is 14. That means it's taking 14 periods or 14 candles in the past to plot information on the momentum of a trend. So you can adjust this. The higher you adjust this, the longer or the less you will see price action trending up towards the 70 RSI. Or the 30 RSI, and the shorter this is, the quicker you will find momentum heads towards that upper or lower band. So talking about this in the simplest of terms, when price action starts trending towards the 70 RSI, we would expect the momentum of that trend to decline. People will be also looking at this RSI and looking to take profits. Conversely, when we head towards the 30 RSI, people are looking to enter the market, or they will be looking to take profits on their shorts. Now, I feel that's a little bit outdated. And what's the number one mistake that most traders will make when we head towards this 70 RSI or 30 RSI? And that's immediately exiting the market, which a lot of the time is sound. But if you want to maintain that profit as we head up and above the 70 RSI, or avoid entering the market too soon as we approach the 30 RSI, you can do this. Go to your horizontal line and plot your horizontal line at 80 and plot your horizontal line at 20. Now you can go to your settings to get the perfect number there and go 80 and here and go 20. And why do you do this? Well, I'm going to show you, and this is a really good example of that. So if we get our vertical line here, and say for example we exited the market here when price hit, or when the momentum hit the 70 RSI, you may have even jumped in back here. That's a great trade, no problems about that whatsoever. But if you want to maintain the profits that you are making and even add profits to the table, set your number at 80 RSI. And then if we jumped out here, let's have a quick look here. We gave back, let's say, almost 18% to the market. Whereas if we jumped out when price hit the 80 RSI here, we gave back 5% if you absolutely caught the top. So that's a really handy way that if price starts breaching out of the 70 RSI, if price action gets towards that 70 RSI, the 80 RSI, I'm out definitively, because there are rarely times where I see anything break below the RSI. And if we look below, this was the exception back in May 2021 when we had that really big run on Ethereum up towards that all-time highs at around 4.4. That's an exception, and the same thing on BTC as well. That may have been somewhere where that 80 period, that 80 line may not have worked, but look at it in the past, how well that has respected. And conversely as well, look at how well that line is respected when we break out of the 30 RSI, particularly lately on Ethereum. And you can apply that to any sort of trading asset as well. So that's one handy little tip to avoid doing that. So let's talk about increasing your chances of a winning trade using the RSI. As I said, we've got the 70, the 30, and the 50 median RSI. In simplest of terms, when we see price action or our RSI trending above the 50 RSI, you can see that we've got this green bar here and this green line. Anything above the 50 RSI, this triggers a green line, meaning that we are, in very simple terms, in a bullish uptrend. We are seeing bullish momentum. And conversely, when we are below the 50 RSI, we consider that to be bearish RSI territory. So what we want to see is a break above the 50 RSI and a touch of the 70 or the 80 RSI. When we head below the 50 RSI, we may be sidelined waiting for price action to hit the 30 or the 20 RSI, where we'll be looking for entry. So the key to this market, in any market for that fact, is patience. I am far more inclined to give or to not secure a few dollars if I know a trend will continue, than trading volatility in every single little move when it's not confirmed or it's not an actual confirmed reversal. So if I'm trading at the bottom of the range and I am trying to knife catch, I would far be more inclined to wait for price action to trend above and see price action close above the 50 RSI, knowing full well that we are headed into confirmed bullish territory, then trading every single little tiny move above or below the 50 RSI. Patience is key in this market. I cannot emphasize that enough. Patience is key. I am far more inclined to sit on a position when I know it's right, rather than trying to trade every single little position. So that's a really great way to secure your bullish profit. And in saying that as well, if we find price action trending above the 50 RSI, when it trends above the 50 RSI, if we see a very beautiful daily bullish candle like this, that is a secondary confirmation for me that we're going to see continued price action to the upside. A very, very beautiful RSI move like this price action candle like this is exactly what we want to see. But here's something else for you as well, and I really don't see many people talking about this, and that's using the combination of RSI and moving averages. As I mentioned a moment ago, moving averages, top right hand corner if you want to learn more about those. What happens when we see RSI pulling back but price action continues to the upside? That sucks. I've been caught out by that many times in the past until I developed this little system. We have our EMA UTG fan, another free tool that I will link for you in the show notes below, or that you can find at our TradingView account. So we have our 9, 21, 50, 10, 100 and 200 EMA. For me, this is really what I want to use, and I set my settings at 10 and 20, but you can use 9 and 21, not a problem at all. So what happens when we see price action sort of pulling back and we see our RSI pulling back? Because a very handy little tip is that we often see the 50 RSI act as a level of support above, and we see it act as a level of resistance when it is below. So keep that in mind. Consider the 50 RSI support when RSI is above, resistance when RSI is below. You see this time and time again. It is pretty profound how often that occurs. So if we see our RSI pulling back and price action pulling back, and we freak out and jump out here. We've jumped in at this point when our 50 RSI has been crossed. We are in bullish territory, and then we see this type of price action occur. We're seeing pullbacks like this, and we go, up, that's it, we're out, we've sold the bottom, and price action continues back up, and we're pissed because we've given profit back to the market, or we've not been able to take as much as what we thought we would have on that particular move. So what happens? RSI starts pulling back. We look for this to act as a level of support, and a secondary confirmation of this would be our price action pulling back into our 10 and 20 EMA cluster. This is called a cradle trade. So what happens is that you've got price action and you've got your 10 and 20 EMA, and price action pulls back to this level, it consolidates, and then it moves back to the upside. So you've got RSI confirmation being your 50 acting as a level of support, and then you have your 10 and 20 EMA cluster cradle trade acting as a secondary level of support, where price action, as long as it closes above that EMA, to me would still be considered a bullish condition. And then what you will find after a cradle trade, the premise of this is that we find price action trending back in towards the cradle of the EMAs, the 10 and 20 EMA, and then we have a solid bullish confirmation where we have a beautiful daily bullish candle, a secondary beautiful daily bullish candle, and RSI still trending above the 50 level. And we see this time and time again. RSI is pulling back, but we are pulling back into this cradle zone. And then what happens here? We find that the RSI has headed below the 50 level. Okay, so now we are considering bearish territory, but we don't get the continuation of this bearish trend for very long. We consolidate in this little period here, but we know that when price action is trending below our 10 and 20 EMA, that it then becomes a level of resistance. And secondary to that, what we can find is the angle of your EMAs are very telling. When we have EMAs trending upwards like this, we are seeing that as a very bullish trend. When we have price action, when we have our EMAs trending down like this, this is considered bearish EMA action, and it acts as a level of resistance. So this is what I mean when we look for two sets of confirmation using EMAs and RSI, and why I would I would be far better off waiting for a solid confirmation than trying to trade this chop and trying to catch the bottom of this move. So let's have a look at this. We've got one. We've trended above our 50 RSI. We didn't find any resistance at this 50 RSI. We now have price action trending above our 10 and 20 EMA. We now have our EMAs pointing upwards. We now have a bullish daily candle preceded by two candle closes above our EMA, followed by more bullish daily candles to the upside. And it wasn't really until here, I guess that doji is considered indecision, so I probably wouldn't be exiting on that just yet. I probably would have been stopped out here, admittedly, but our 50 RSI is still, or our RSI is still above our 50 level. So that would be one sort of form of confirmation telling me that we could potentially hold that trade. But then it wasn't until we had price action again trending above our 10 and 20 EMA that for me, that was a pretty solid confirmation. But this entire time, we never really had a solid close below this 50 RSI. So using your 10 and 20 EMA along with your RSI and your 50 median line, and this RSI in particular telling you bullish and bearish zones visually, is a really powerful tool to stop you giving money back to the market or exiting or entering positions prematurely. Pretty cool, right? I don't see many people talking about that. So I really hope you use that to your benefit. And you can come into the Discord and ask me if you like more about this, because this is a staple of my trading system. Absolutely. So let's talk about one last thing before we wrap this up. And this is called Divergence. Now, you can use a tool called the CCI, which is the Commodity Channels Index, to accentuate divergence. Or you can do it like what we do and use RSI Divergence. And of course, we've created, I've got you. We've created an RSI cheat sheet, a divergence cheat sheet, which you can print out, put above your trading station. And what divergence does is help you identify hidden potential entry levels and hidden potential exit levels or short levels. Now, let's talk about what divergence is. So bullish divergence occurs when when RSI is making is giving you a different set of information than what your oscillator is doing. So let's look at regular bullish divergence. We have price action making lower lows, and we have our RSI making higher highs. If we talk about bearish divergence, we have our price action making higher highs. We have our RSI making lower lows. That's bearish divergence and bullish divergence. Now, what is that telling us? That's telling us that the momentum of this RSI, the momentum of the upward trend is coming to an end, and we really want to consider taking profit or entering shorts, because our momentum oscillator is saying this is coming to an end. We are starting to now trend downwards. The sellers or the take profits are starting to enter the market, and the sellers are starting to enter the market, or shorts are starting to build up. And then we've got hidden and exaggerated. So hidden is when our oscillators are making lower lows and our price action is making higher highs. Our price action is making lower lows and our RSI is making higher highs. But you see the difference in plotting your trend lines being above for bearish and below. We're looking for resistance on our bearish divergence, we're looking for support on our bullish divergence. Now, this is why it's such a handy little tool that we've created, and it's yours for free. Just go to our TradingView account. You can go here and you can turn these levels on. So let's look at bullish, regular bullish and regular bearish divergence here as well. This is a really good example. We have, well, you tell me what we have. So we've got price action making lower lows. We've got our oscillator making higher highs. This is telling us that there's a trend strength beginning here, yet price action is telling us, if we looked at this only, is that the sellers are in control. But from here, we had moves to the upside. So we had a potentially 10% move on our RSI that we missed because we weren't looking at hidden bullish divergences rather. So let's have another look at an example here. We've got a bearish divergence here because price action is making higher highs and our oscillator is making lower highs. It doesn't line up. So our RSI is telling us different things to our price action. Now let's have a look at some hidden levels of bullish and bearish divergence. Oh. Boom. Boom. And you can see how price was affected at this level when our oscillator was making lower lows and our price action was making higher highs, and then we eventually fell from that point. Our oscillator was making lower lows and our price action was making lower highs. So you can see how in this cheat sheet here, how it gives you that visual cue very easily when it comes to spotting divergence. So a really, really handy little tool that we've created for you that tells you everything that you need to know about spotting divergences. Now, I don't use divergences a great deal of the time because I'm more interested in holding positions for longer, as long as we're trending above our 50 RSI and we are holding spot, or we're holding our positions based on our EMA strategy that I showed you beforehand. So that's it. Let's recap. 0 to 100, 70 RSI, we're considered to be in overbought territory. 30 RSI, we're considered to be in oversold territory. Our 50 median RSI, above the 50 bullish, below the 50 bearish. If we have price action trending outside of the 70, we look towards the 80. If we have price action trending outside of the 30, we look towards the 20 RSI as our sort of our final levels where we expect price to start reversing from those particular RSI levels. A really handy little tip there. We've got divergences, we've got bullish divergences when our RSI is making higher highs and our price action is making lower lows. Bearish, price action making higher highs. RSI making lower lows. You can download this free cheat sheet from the guide that I will put in the link below as well. And you can find this over at our UTG Trading View account. So thank you so much. If you are picking up what we're putting down, as I said, make sure you hit that subscribe button. Come on over into the Discord, hit that alert icon and get instant updates every single time that we go live here for weekly market updates and producing more content like this. I am Tex. Thank you so much for joining me. You have absolutely no idea how much we appreciate it, and we'll see you very, very soon.